warm welcome. You're watching Closing Trades in 80 now. I'm Anisha Jain. With me is Aisha Faredi, and it's not a great trading session if you're a bull. In fact, we are staring at further losses and deep cracks in the markets at the moment. We went below the mark of 23,704 now. This sell-off which really continues in the market. All the sectors are trading in the red. In fact, if you look at the Nifty, over 45 stocks are in the red right now. Only a few handful of stocks which are in the green. Nifty is hovering very close to that crucial 200-day moving average, which is closer to 23,550 thereabouts. So that's a very important marker that we need to watch out for. Small cap index has already drifted below the 200-day moving average. It's the first time that it's gone below the 200-day moving average in April 2023. A lot of sectors in the red. In fact, all the sectors are in the red. It's metals, real estate and PSU banks which are seeing the largest amount of dropping in the trading session. So a lot of red on the screen. In fact, let me take it across to Ansh to get more details on the market setup. Ansh, clearly not looking good at all on the screen and very close to important technical factors that we need to watch out for.
That's right, and we are seeing actually a massive market cap erosion of almost around the 6 lakh crore today. So if you talk about Nifty, Nifty has broken its November lows, which was around that 23,800 mark. And on option front, we are seeing call writing happening at that very same 23,800 mark, indicating option traders are expecting strong resistance at this level. So this is the level you should watch out for on upside. But on downside, we have 200 DMA at around 23,545 level, which may provide some support. Now, if you talk about sector-wise, then we are witnessing sector-wide selling today actually. Realty, auto, energy all have touched 5-month low. FMCG has touched 4-month low. Pharma and metal index has touched 2-month low level. Also, if we talk about market breadth, then that also looks very ugly because here we are saying it is very extremely weak. More than 80% of Nifty 100 index stocks are trading in red and more than 90% of mid-cap and small-cap are declining. So yes, it's a very bearish session today.
Indeed. In fact, let's throw more light on what really does this weak session actually imply, given that the market has been facing acute weakness all through this month and the previous month as well. Dhananjay Sinha as well joins in on the show. We've got Naresh Mirani too. Naresh, let me come to you first. What does this crack of the 200 DMA mean, and what kind of downside does it further open from these levels now?
So a crack below that 23,550 would not be something which we'd look out on a daily basis, but the band at 23,300, which is the high which we made on the opinion and poll day, and 23,550. So this is the area where we should start looking out for a reversal signal, 23,300 to 23,600. So that's the band. So we'll wait for a couple of days, see how price action is over here. Ideally, we are oversold. We've made RSI positive divergences. So this is a price point where you want to look out for reversal signal rather than selling more.
Watch out for the reversal signal when it comes through and instead of selling more. So clearly hoping for a recovery. But that's been the case, Dhananjay, for a while now. All through October, we were hoping that there will be a bit of a turnaround. 24,000 will be that bottom. Yes, earnings season has been weak, Dhananjay, but is it that weak that we have given up over 2,000 points, and in fact 3,000 points almost from the highs?
Yeah, I think the market cap is actually from the peak if you look at the Nifty, it has fallen by roughly about 44 lakh crores. Actually, it's almost like 8%, and as percentage of GDP, it will be about 10 odd percent. So I think there is a considerable sort of decline, erosion in the valuation that is happening, and I think that is happening with the earnings seasons, earnings trajectory showing up till now. Of all the listed companies, there is a contraction of about 13 odd percent. And last quarter also there was about 2 to 3% contraction. So I think the second quarter is sort of consolidating the view that the earnings trajectory were far more optimistic. So I think what is happening in the current season is across the board, especially in the cyclical sectors, there is a massive cutback in earnings and stuff. And look at steel, you look at cement. There's a margin pressure happening across the board, and we have seen numbers from consumer goods industry as well. So I think by and large, what is happening is that the market, which was largely driven by flows, especially the retail flows, have actually started to align with the market fundamental, which is earnings growth. And I think what is also adding to the multiple contraction is the fact that your global factors which are which are feeding into valuations, is let's say the risk-free rate. U.S. yields have gone up to 4.35% from a low of 3.80 or something. So I think that is also sort of compressing the valuation. And apart from that, there are valuations issues, the volatility, the uncertainty issues are there as well. So I think these are the things that are there, which are actually weighing on the market. People had expected that the re-election of Donald Trump would be positive for India and flows from an FI standpoint. It has not really translated. So I think these are the things that are there. I would say going forward, people would look for a better second half. A lot of companies are relying on better rural demand and better, margins, etc. So that's the hope that people have. At this juncture, momentum seems to be fairly weak, and there doesn't seem to be much support coming from flows, even from the retail investors in India, as we are saying just now.
So, Dhananjay, you obviously wouldn't recommend buying the decline just yet, right? Or do you think there is some sort of sanity and valuation froth which has cooled off enough in certain pockets or segments of the market and one can buy right now?
So I would say that you see a lot of the headwinds that we were expecting is just about started. So I would say that we are not in a scenario where I would say that the earnings trajectory will start to bottom out. So I think where what we will need to really look at is a scenario where there is a significant correction in the commodity prices, for instance. Let's say the commodity prices fall by, let's say, 20-30%. Typically that happens when the capitulation happens, is where the margin starts to bottom out. So I think we'll need to wait for that. I would say that uh, some of the stories with respect to rural revival, etc., can start showing up in the second half, because of better monsoon, etc., that will start showing up. But I would say that it will. I think the next cycle in terms of earnings will arise only after a significant correction in commodity prices. So I think a lot of these things are yet to happen. I think the other issue is what is happening to the banking sector and the lending sector. We are seeing some signs of rising NPAs in the microfinance and NBFC sector. There is certain curtailment in lending growth, etc. All those things have just begun happening. So I would say that we'll need to wait. We need to be conservative. We will look for sectors that are less vulnerable to this kind of cycle.
Yeah, looking for those sectors which are a bit, which are less vulnerable at the moment. But Dhananjay, what the defensives of sorts, and I'm talking about, let's say, the IT and the pharma and the consumption of the world, be better placed than?
Yeah, I think we are hoping so. I would say in the overall correction, everything starts to correct, but I would say that some tailwinds would start to emerge. I would say pharma has been doing well recently, it's starting to correct, but I think pharma is one place that can be looked at. Even IT, I would say IT, we like the space, especially because we think that the tailwinds for them from a medium term standpoint, or let's say 2-3 years standpoint, might actually pan out. I think hence the correction and all in the space might be looked as an opportunity. See, the defensive space also includes staple companies, wherein we are seeing that companies are finding it difficult to sort of show significant volume growth trajectory, and there is a sort of tapering in the volume even for the premium segment. So I would say there is certain misses that consumer companies are showing, but I would say these are much lesser compared to relatively better compared to deep cyclical. Let's say if you look at cement industry, or let's say I would say steel as well, where the contraction in EBITDA is over 50% for many companies. So I think at some point of time, as the consumer companies start to sort of see better valuation, people might actually start to dip into the correction over there. So I think those are the places where I think people can start looking at valuation. But at this juncture, market seem to be very volatile, and and the momentum is something that will be very difficult to turn at this juncture.
That's a take coming in, and some of these defenses are better placed. Of course, they might also correct with the rest of the markets, but hopefully the magnitude of correction is expected to be lower. What's holding out today in the trading session today? Then some of the pharma names, Cadilla, Suvin Pharma, Piramal Pharma, they are seeing a bit of a recovery at the moment. KNR Construction is a result reaction, so that's holding up. You also have names like Bharti Hexacom, which are actually coming back. Vodafone Idea is down in the trading session today. Remember, it comes out with earnings, so just watching out for that one. But overall, the telecom space too has been fairly volatile, and then some of these chemical names are holding out okay. Aviniti Organic, GSFC. These are some of the names in the green. On the losing side, a Techno Electric is down, a Suzlon Energy is coming under pressure, and then Century Textiles too down in the red. In fact, real estate as a pack has seen quite a bit of pressure right now, Naresh, whether it's Century, whether it's the rest of the names, because that's one of the biggest loser in terms of the sectoral indices today. Any buys which are emerging at the moment?
Would wait for some more time, given the kind of rally we had seen in Nifty Realty in the 2023 bottoms till now. So would wait out for some more time. They are sectors which generally have a high beta. So would look at it once we start seeing a signal of bottoming out on the Nifty, not as of now. And that would continue to focus on a DLF or a Godrej properties, which have started correcting right now.
Okay, that's the take coming in on realty. But Naresh, since we're talking about it, let's also address the weakness that one is seen in blue chip names like HDFC Bank, SBI from within the banking pack of late. Of course, today there's an RBL as well, which I can see, a Bandhan Bank also, both knocking down about 4% or so. But specifically on the charts of SBI and HDFC Bank, what do you foresee? And then, of course, your call on the Nifty Bank.
So if you look at HDFC Bank, the same struggle continues around that 1780, 1800 mark. We saw recovery. The stock was holding on around that area. Now we've broken below 1700. We go back to the same zone, which is where 1600, 1650 has been a support for the last 3-6 months. So that should be an area where it should find support. State Bank of India similarly tried to make a breakout move above 800 odd levels, went to 860, is now back to 800, 820 band. Multiple supports around 770. Similarly, on the Bank Nifty, the last few lows, if you look at it, is around 50,200, 50,400, and then 49,500. It's already at an equivalent of 23,000 of Nifty. We are back to the prices which Bank Nifty was on the day of elections. We are getting into that band. So overall, we are getting to support area for both the Nifty as well as the Bank Nifty.
And that's the take on Bank Nifty at 1200 point cut. Did I see that right? So it's just getting worse. In fact, the Nifty also at the lowest point of the trading session, and the 200-day moving average that we were talking about is at 23,545 if I have it right, and we are very close to that. In fact, for the Nifty, below the mark of 600, clearly 563 is where we are at, so not very far away. Let's take a look at which are the drags for the markets right now. Of course, everything is in the red, but just talking about the heavyweights that might be causing pressure to the markets at this point of time. And on the losing side, there are some of the names which will come up from the banking industry, my guess is. So HDFC Bank should be under pressure. Reliance should be the one which is under pressure. I'm missing out that data point at the moment. It's not really reflecting for me, but I'm guessing some of these heavyweights are the biggest pain point. Even SBI, ICICI, they all would be under pressure. Dani Ports, Apollo Hospitals. It's the entire market which is actually reeling under pressure. We'll do one thing. We'll take a short breather on the show and come back and track more on the markets because it's getting very volatile. Let's see whether we recover from here on or continue the slide downwards.
Back with closing trades right here in ET now. Quite a bit of shake off. Over 300 point knock is what you're seeing right now. It's actually senseless even marking the winners today because they too are really unable to hold on to the greens. ITC, Tata Motors, Unilever, very, very skittish there as well. Hero MotoCorp down 4% now. Hindalco down nearly 4%. Tata Steel is seeing acute pressure. Autos, of course, has been the weak link from the word go. and one of the more resilient and the strong names within the auto pack. Even M&M is seeing quite a bit of slide. It's down about almost 3% as we speak right now. There's BEL, Apollo Hospitals, Bajaj Auto, SBI, HDFC Life, Reliance also down about a good 1.5% as we speak right now. Let me take it across to Naresh then. Naresh, we've been talking about Reliance and the kind of crash that the stock has seen. What happens next at 12.50 thereabouts now?
At these prices, it becomes an interesting bet given the fact that it has connected 20% from the top. It is to the prices where it was in start of the year, so the full year return is zero. The stock is almost at the same prices where it was back in 2022 if you remove out the geofinance impact. So overall, the stock has gone nowhere now for in terms of 1 to 3 year return. That looks very interesting around this 1250 mark. The stock, the lowest point in the last 2 years has been a low around this 1100, 1150. Not much of a downside here. It could eventually bounce back towards 1400, 1450. So a good time to accumulate Reliance Industries.
Perhaps accumulate Reliance this morning. CLSA also was voicing similar opinion, but Rohit Srivastav also joins us to make sense of the technicals of the market. Rohit, acute weakness which is underway. We were hoping that there would be a bottom perhaps at 24,000, or there's going to be a bit of sideways move from 23,800 to 24,200. But now even that 200-day moving average is getting threatened. We're 10 points away from that. What's your sense? We're headed lower, or at least there's a bottom in place close to these levels?
No, I think the odds are shifting to a much further decline from here, especially with the Bank Nifty joining the sell-off today. Bank Nifty breaking 50,500, which I spoke of in the afternoon earlier with you. That sort of sets us up now for around 48,300 on Bank Nifty. So that's a pretty significant further down move from here, which will further add to the downside in the index itself. So I don't think the selling is done. I think 23,500 is the next level that a lot of people will be watching, for some potential support. It's possible you get some kind of an intraday bounce today or tomorrow from there, but once that breaks, then we may look at 23,300 or 23,100.
Pawan Parekh as well joins in on the show right now. Pawan, seems like very India-dedicated kind of selling, and from all the charters that we've been speaking to, they seem to be indicating that the selling is quite not done yet.
Yeah, I think it's difficult to take a call on FII flows, and and as I speak to a lot of technical analysts and chartists, even I get a feeling that maybe some downfall is still pending. But if I were to take a fundamental look at the markets, what I would actually say is that, while quarter two results hasn't been so very great, but you should also keep in mind that quarter two was marred with monsoons and heat waves and floods in several parts of the country. And Q1 was obviously marred by elections. So actually, in the real sense, what you should be looking for is Q3 and Q4 in terms of corporate India's performance. And I wouldn't be actually so negative on the market as much as the kind of fall we've seen in the market. So actually, I would actually advise investors to participate, and use this rally to build long-term portfolios.
So Pawan, the point being that where is it that you see further EPS cuts coming in, and where do you see further earnings pressure? Or are you saying with Q2 being an aberration because it was the monsoon quarter, and the next quarter is going to price in the festive demand itself, etc. as well? Are we going to see an uptick then? And do you think the earnings, misses may have bottomed out with Q2 alone?
I would actually strongly feel that, earnings misses have actually largely bottomed out with Q2 alone, because, if you look at the corporate India performance, two sectors primarily which have actually disappointed a bit is, one is on the banking side, wherein, unsecured exposures, people have seen uptick in NPS. And second is in terms of consumer sector, wherein we've seen some slowdown in demand, As things stand today, we understand that festive season has been reasonably decent, not great, but reasonably decent. And given on the banking side, given that these unsecured loans are short-term products, I would want to believe that we've already 2-3 quarters into this thing, and maybe 1 quarter or so. So So in terms of both these sectors, I would want to believe that a lot of the analyst estimates have actually factored in a moderate Q3. I would want to believe that, earning misses have largely been, earning downgrade cycle is largely over. I don't see a major downgrade to earnings from Q3 result onwards.
Hold that thought. Let's go back to Rohit and get a better sense. Rohit, are you looking at buying anything into the markets right now, which is looking good in terms of the correction that we have seen so far? Or you're just sitting on the sidelines and waiting for this entire poison to be out? Anything that looks better on a relative basis?
No, I would rather just sit out. That appears to make more sense at this moment because, it's like trying to catch a falling knife and you don't know which is the next shoe to drop. For example, you did see banking hold up for a long time now. You may point towards IT, which is holding up, but we never know when that gives up as well. So I think it's much better to let the poison go.
We're perhaps headed for much lower levels, Rohit. What's the next level? So 23,500 is one marker to watch out for. If we break below that, what's next for us? Are we headed much lower? Let's say another 1,000, 1,500 points slide? Or is it going to be a bit more shallow from here on?
So like in Bank Nifty, I've given a level which is closer to 48,300. Now, what will be the impact of that on Nifty? We can think of 23,300 to 23,100 as the next set of levels. Can we get lower than that? I will not rule it out because we are going to be trailing this entire move on the way down rather than, saying that, okay, this is the level where it is done. And as we continue to trail, then we'll keep coming up with new levels. So it's not going to be a particular point which is going to define, okay, this is where this comes to a halt.
Rajesh, hi, afternoon. What is your own sense? Of course, the Nifty Bank has seen quite a sharp hit. We're already looking at a 1,000-point decline, in excess of that, in fact. But what are the other sectors which are looking the weakest to you? And if the market were to fall further, what's going to contribute to the drag the most?
Yeah, good afternoon. So looking at the fall, we believe that, a part of this banking stocks, I think auto as well as FMCG, these two sectors are also looking bearish. The way automobile index has given a breakdown of their upsloping channel, I think there could be furthermore follow-up selling we could witness in automobile stocks also. And FMCG whole basket is looking weak, and we believe that here also there could be furthermore pressure, as most of the large cap stocks from the FMCG basket are now almost trading near to their critical support area, and some of the stocks are already broken their weekly as well as the monthly support area. So I think these two baskets can be furthermore dragger for the Nifty, and now Nifty is almost trading at 200-day moving average. So I think any further fall below 23,500 can open the furthermore downside for Nifty also towards 23,100 to 23,000 level. So I think there is no as such halt at this moment, and across the board supply pressure is happening in the market. Even power sector is also looking weak at this moment. Most of the power stocks are looking bearish. Tata Power has broken its important support area. Here also we could see further more fall. So I think these three sectors, power, FMCG and automobile, these three sectors can be looked at for further more downside in the coming sessions.
That's the view coming in from Rajesh. But Rohit, just coming back to you and getting a better sense, what would you attribute this weakness to? Do you think it's more fundamental in nature, or is it related to the FII flows, or this is a technical pressure that was kind of building up for the markets, or is it perhaps the derivatives changes that we are expecting, the changes in contracts, the increase in the overall frequency, and the changes that have happened with respect to the expiry weeks, etc.? What would you attribute this weakness to?
Many of the factors that you're outlining were building up over time. So at the time they were building up, some of them did not have an immediate impact. Now that the markets are falling, we may try to attribute it to many of those things. But one of the things which is happening globally, and if you notice that while you see a US market rally at this moment, you're actually seeing a sell-off in various other markets. That means you can see Europe selling off, you can see parts of Asia also selling off, whether it's Korea, whether it's Malaysia. And so what it really looks like is there's been a movement out of various markets that are non-US. And that is actually having an impact. And that we can attribute to what has been a rising dollar. The dollar has actually, bottomed out late September and started to rise from there, and has been going up for quite some time. So I do think that the rising dollar could be one of the direct causes that is affecting flows to various emerging markets.
Pawan, coming back to you, so you talked about you are expecting this earnings season perhaps to be the bottom when it comes to the weakness that we have seen in the earnings. But which are the sectors do you think will outperform with respect to upgrades from here on? Let's say 6 to 8 months out, which is that sector or segment where you're expecting the biggest amount of upgrades to come through?
I think very clearly IT is one sector, with where we think, in the current scenario when US policies will be far more inward looking and tech spends have been quite low for about 2-3 years now. And dollar is also appreciating. Clearly, IT is one sector which should hold up, and potentially there could be further earning upgrades in that sector. The second sector which I think can see potential upgrades is on the banking side. I would want to believe that a lot of these analysts, a lot of these companies have actually preponed their provisioning norms, and probably Q3 will not be so bad in terms of the slippages. At the margins, you could see some moderate earnings upgrade in banking as well. And third sector, obviously, which we think can do well is industrial, because a lot of the noise that's happening on the consumption side. But if you look at themes in terms of capex cycle revival, all of those things have been pretty well. So I think those are sectors which I would look up to, both in terms of earnings recovery and stock price performance.
Okay, so that's the view coming in from Pawan, but a very important technical marker now being broken. Remember, we were highlighting to you from the last 1 hour that it's threatening that perhaps 200-day moving average is going to be broken, and it has finally happened. It's the first time in 18 months that we've gone below that mark. We have seen accelerated FII selling over the course of last couple of months. We have seen the earnings being, subpar. A lot of changes coming in with respect to the F&O and the derivatives market, and the entire US election and the kind of dollar flow that we have seen in the Trump trade really playing out. Rajesh, what's your sense? Where do we go from here on? You talked about auto seeing a lot of weakness, but let's say PSU banks, which were underperforming earlier, or PSUs as a whole, which have seen a bit of a correction, and they were the ones which started the correction per se. Will they be the first to recover as well, you think?
No, structure is very weak for most of the PSU stock in this decline, and I think there would be some recovery in the once the market supply pressure halt at certain level. But I think the sector which are still holding the ground on the technical front, like stock sector like IT, pharma, these two sectors are still able to hold out ground at higher level and able to hold out on the short term charts. So I think first recovery would likely to be in these two sectors only, and then gradually once there would be stability in Nifty as a benchmark index, then only we could see the some recovery to take place in PSU basket also. But I think the structure is very weak for most of the PSU stocks, and the way this sector has corrected in last couple of months, I think it may take time to recover. It will not recover faster. So in recovery, we would be looking to buy stocks from pharma as well as from the IT sector.
Right. Okay, Rajesh, great to have you on the show. Thanks as always for taking the time out and speaking with us. Let's just mark where is it that we are headed. No recovery whatsoever in sight now that we are below the 200 DMA on the index alone on an intraday basis. For the first time in about 18 months, this surely opens further more downside for our markets, on the brink of even breaching that 23,500 print now, and it's a good slide of about almost 370 odd points that you're seeing. But Pawan, what's the chatter that you're picking up? Because if you look at the SIP inflows, that's definitely not abated. Maybe next month you will see an aberration, but that doesn't seem to be happening. The DII participation very much is intact. And, this, irrespective of the flurry of IPOs also that we've seen in the past month up until now, what will make FIs really come back, you think?
No, I think clearly, I think at least for now, the trade is, so October month was trade was largely around money shifting from India to China. And now with, as we just discussed, now with Trump around, I think, the trade is favor of more inward-looking U.S., which means that U.S. economy will be far more stable than in the recent past. And hence, I think the money is perhaps moving from emerging market economies, largely India to US. I would think that, it's already been 1.5 months we into this trade, maybe 10, 15 days, or, it's difficult to take a call, but I would typically believe that, given that India's market cap contribution to the global market cap is about 4%, but India is contributing 15 to 20% of incremental global growth, which essentially
view coming in from Pawan as well. Let's go back to Naresh and get his sense as well. Naresh, we were talking about that 200-day moving average. You said it's crucial, but not crucial enough. You're watching out for 23,500, I believe, but that is too likely to get broken very soon. 14, 15 points out.
So this is the whole band, which is where you look at the support zones. We do not see bottoming out happen exactly around the 200 DMA or at some price points. If we look at 23,300 is where we were on the opinion poll highs. Pre-elections, the high was 23,100. You have the 200 DMA around 23,500 odd. So multiple bands of support in that area. We are oversold on various timeframes. And we've diverged well enough from the global markets as well. So this is not the time where you want to sell. You want to be looking out for a reversal signal. How do we look out for a reversal signal is when we start seeing a 250, 300 pointer, 1.5% uptick from the lows, and it holds on for the next 2-3 sessions, that would indicate a short-term bottom is in place.
Naresh, hold on to that thought. We're going to take a very quick break on that note. Come right back and we'll continue tracking the weakness in the markets on the other side. Back with closing trades, right here in ET now. The closing trades, of course, are taking quite a rumble. It's a truncated week. You've got a lot of macro data, especially the inflation shocker that the markets are also absorbing. And other than that, at the fag end of the earnings, trying to pencil in and digest those earnings misses and price in the further EPS cuts that may actually come in. That said, we've already corrected a good 10% from the, from this year's top on the Nifty, but still up 8% for the year, at least on the index alone. But that said, right now, of course, it's metals and autos. That's the, the sectors which are weighing most heavy on the indexes right now. Banks and other heavyweights like Reliance, the underperformance as well continues there. So really not helping the index at all. In fact, all sectors are in the red right now. Even IT and FMCG haven't been able to withstand today's fall because they too are in the red as we speak. Even a Jubilant Foodworks, for instance, which actually jumped up yesterday, post its numbers, it's completely turned tide. I can see a Tata Consumer, even a Bata, India Mart, Nestle, Asian Paints, even the allied larger, consumption theme that also has been caving in any case post earnings, and today is no different over there as well. But Pawan's back with us. Pawan, just wanted to understand where within the entire consumption basket you think the selling may be now done with and one can at least start nibbling in.
See, I think one thing which is very clear is that, the selling that's happening, is across the board. It's fairly secular. And it's not, and the selling is clearly driven by the need to exit India and not driven by the fundamentals of each and individual stocks. Having said that, I must tell you, consumer discretionary as a basket, if you see a lot of the categories have done reasonably well. So jewelry has done reasonably well, apparels have done reasonably well. Some of the retail companies and the apparel side have delivered decent set of numbers. I would want to believe that, with this decent festive season, which has largely been in Q3, these themes will further accelerate, and, valuations after the correction have become very, very, very palatable. So those are the segments, which I think should do well, and segments where there is a reasonably good amount of earning certainty.
Okay, let's see whether that happens or not. But for now, it's a sharp cut that we have at our hands. 200-day moving average broken. On an intraday basis, we just managed to defend the 500 mark, 23,500. That's the level Naresh was watching out for. So at least for now, we went to 23,509, and from there made a bit of a bounce back. But it's a very, very feeble attempt of a recovery, at least at the moment. 15 minutes left for the trading session, so let's see which way it closes, but definitely a 350 point slide is what we are witnessing on the stocks right now. The biggest losers are HDFC Bank, ICICI Bank, M&M, Reliance and SBI. In fact, SBI is down 2.25%, but it's HDFC Bank and ICICI Bank which are seeing the largest amount of pressure. Surprisingly, it's Tata Motors, Britannia, HUL and NTPC which are holding up in the green at the moment. So a bit of an outperformance, if you must, from some of these names. What do you think, Naresh? Has FMCG bottomed out a bit? HUL, Britannia holding up in this market?
So I would say bottoming out, not necessary, but a bounce could be in play given the extent of the correction. So if you look at HUL, the stock was at 3,000 plus. Now we are at 2,400, 2,500. So it's seen a good 15-20% correction across. Same is the case, Dabur from 670 down to 500 odd levels. And now 480 to 500, the stock was back in 2022 as well as back in 2020. So overall, the correction has been large. The last 3-5 year returns come down to zero. So there could be a dead cat bounce across the whole FMCG pack purely for the fact they've corrected 15 to 25% from the top.
Point taken. What's holding okay in this market is actually Swiggy. It was expected to make a very lukewarm listing of sorts. The subscription wasn't, blow away number of sorts. It was decent at around 2-3 times, but the retail portion was a little less subscribed. In fact, Swiggy has piled on gains. I think it opened with a gap up of almost 6-7% or 8% thereabouts. It reached a level of 14%, and right now it's 16% higher. We all saw that camaraderie between Zomato as well as Swiggy with the update coming in on Twitter. Even Dipinder Goyal put out a tweet welcoming them to the bosses, and seems like the street, despite the market mood, has welcomed them with a bit of a green. Pawan, any view on this space? Because on one hand, of course, this was a disruptor and kind of filling the gap that the consumers needed, but on the other hand, it looks like there is some lobbying against the quick commerce bit a bit, and the government and certain at least bodies are coming with a bit of a heavy hand on some of these.
I think, these things, I think both these companies have seen quite a lot of this in last 10 years or so. I think earlier also there was a chatter that some institutions or organizations will develop a competing app against Zomato and Swiggy, but none of that has happened. I think it's a very tough business to execute on the ground, and given the work that they've done on the quick commerce side, that had actually further strengthened their fold. I would want to believe that there is no scope for more players on the food delivery side, and then the consumption or growth in terms of GMV and in terms of user addition that is there on this platform will only further increase from here on. The only thing that I'm really worried about is that what is the fair value for these companies, once this growth tapers off in next 3 or 4 years. Maybe next 3-4 years, the growth will not be 25-30%, maybe about 15-20%. At that point in time, what is the valuations the market would want to give at that point in time is a question in my mind. But until then, in next 3-4 years, we like these businesses and we are kind of invested in these names as well.
That's that, and quite surprising as it may be, Swiggy is one of the resounding winners today in an otherwise such a weak market, 17% higher on its debut day. On its way to clock now an 18% premium to its issue price. 459 is where Swiggy is, and decent set of volumes as well clocked in on its day one. But other than that, we were just mapping how much the sectors have actually cooled off or fallen from their 52-week peaks, and it's actually the media sector, a good 25% fall. Oil and gas has come down quite heavily with almost a 20.5% cut. Even realty, the sort of poster boy of the recovery since COVID, this has been one of the very resilient sectors that's also fallen a good 19% from its 52-week highs. But again, this is the fall from the 52-week high on a net basis. through this year, most of these sectors would still be sitting at gains. But yeah, it's losses galore throughout. I can't point any sector which hasn't fallen from its 52-week peak. It's largely healthcare, the services sector, banks to some degree, and IT definitely, which are a lot more resilient and have fallen a lot lesser than what some of the other sectors have done. But Naresh, do you think that Nifty IT, even though it's fallen only 3% from its 52-week peak, if the market were to correct further, it's not going to fall further with the market and will continue its show of resilience?
So I would expect it to continue to show resilience, given that there is a lot of correlation with US indices over there. So out there, we've clearly seen good recovery. And mind you, from 2021, the returns are not great. So the bounce may look large from the recent lows of the last 1 year, but they've not done really well in the last 3 years. So overall, in that scenario, would expect it to be resilient, may not rally and make into new all-time highs, all of them. But some of the IT companies do look very interesting on a technical basis. Something like a Wipro, HCL Tech still look very strong.
Okay, point taken. That's the view coming in on some of the IT companies. But we have been speaking with a whole host of other market men as well to try and understand what the mood is like. No better time than right now to take stock of that. There is a bit of a recovery. We are attempting that 23,600 mark. But here out the latest commentary coming in from some of the market veterans.
While earnings are soft and have seen a very distinct moderation across the board, the picture looks slightly better if you account for the big drag from a few of the commodity-oriented sectors. For Nifty also, the earnings are flat. But more importantly, the internals of the earnings are very weak. As you mentioned, we've got earnings of about 100 companies by more than 3% for FY25, and we have upgraded for only about 36, 37 companies. So that is close to 3:1 in favor of downgrades. Secondly, we've cut the earnings for Nifty also, the EPS, by close to another percent in the interim review that we did. This comes on top of the 3% or 3.5% earnings cut that we did at the time of preview. So net, if you see from April to November now, our EPS estimate for Nifty are down close to 8%, from 1,140 rupees to now about 1,060 rupees. Which basically means that FY25 is going to be just a 5% earnings growth year, right? We are not used to single-digit earnings growth for the last 5 years now. Between FY20 to 24, every single year was a double-digit earnings growth year, and we've had a 21% earnings compounding between FY20 to 24. So clearly, FY25 is occurring as a bit of an outlier in a 5-year, 6-year trend, where things are slowing down a bit. There's moderation, there is a breather. And of course, it's also a reflection of the government spending being down. FY25 is occurring as a bit of an outlier in a 5-year, 6-year trend, where things are slowing down a bit. There's moderation, there is a breather. And of course, it's also a reflection of the government spending being down. First half, the government spending is flat. CapEx spending is down 17%. So let's hope that second half, the government spending picks up, CapEx spending picks up. There's been a good monsoon, so consumption, which has been the weakest point in this earnings season, also revives a little bit because the Kharif crop should be good. So these are the things as we stand here. As regards your question on sectors, so in this quarter, we have seen very strong performance from PSU banks. In fact, they are the only component of our coverage universe where we have seen 6 out of the 6 PSU banks that we track have beaten our expectations. Apart from PSU banks, healthcare has been good. They've also met expectations. Real estate has been very good.
The total amount of foreign holding as of the 26th of September, which is when the selling actually began, was about $1 trillion. They've sold since then roughly about 12.5 to 13 billion. That's only 1.2, 1.3% of their total holding. It's a very tiny amount in the big scheme of things. So realistically, taking that much money off the table is really not a big deal. Question is, if they were to take that figure of 1.3, 1.4 to 2.5 or 3% of their total holdings, then I think we have a situation where the market could trend down further.
Okay, that's that on the markets right now. But Pavan, what's your own sense on where the buying would first come in? I know you ruled out that it's not going to be PSUs, given that they were the ones which first took the hit of the fall, some of the fancied names from defense and railways in specific. What's likely to recover the fastest, you think, whenever we, get out of the froth and the poison in the system?
I think one sector which I think from a large cap perspective and very specifically large cap, I think should do well from here on is just the BFSI sector. I think except for if you look at the results of the top five banks, which is HDFC, ICICI, Axis, Kotak, and SBI, none of these companies have actually shown red signals in terms of NPAs. And what we understand from our channel checks is that of late in last month or so, deposit garnering has been quite decent. So I think one of the key reasons why this sector was marked down was the mismatch between deposit and credit growth, which I think will start correcting gradually in next 1 or 2 quarters. This is one sector which did not participate in the rally at all in last 2 years, except for ICICI Bank, and the valuations are very comfortable. So this is one sector I think wherein clearly, and this is obviously a large sector. FIIs have always been overweight. I mean, have had large positions in this sector. This is one sector I think wherein you should see some green shoots in terms of FII buying going ahead in next couple of months.
Right, it's banks. Naresh, do you get the sense as well that the recovery too is going to be led by BFSI, that's banking and financial services names? You think so?
Yeah, so that is a sector which has not done well post-COVID. And even in the short term, even in the last 6 months or the last 3-4 years, that's the sector which has not done well and looks interesting. The large cap banking space, many of the names are at the same prices where they were in 2020 to 2022. So going forward, that could be the place which could take leadership, and generally tends to see a lot more pressure when FIs are sellers. And once the selling bout gets over, it could be banks and financials purely for the reason they've gone nowhere for a long time. And they are the places where one could see more momentum as we keep going higher.
Okay, banks on the way down, banks on the way up. That seems to be the trend which is building up. But just looking at the screen today and the heat map, look at a GNFC, for instance. That's down a good 7.5%. Metropolis posts its numbers. That's seen a slide of about almost 5.6% as well. RBL, Bandhan Bank, both those stocks have knocked off about 4.5% apiece. Cummins as well has seen a decline of about 4.5% coming in. There's Hindustan Aeronautics down 4.25%. And then, of course, there are the big boys, Hero MotoCorp, which is down 4%. The biggest drag on the index today, Tata Power, which has lost about almost 4%. Hindalco, which is down about 4%. There's IDFC First as well, which has seen a crack of about almost 4% coming in. Motherson Sumi as well, down a good 3.6%. And the realty names led by Oberoi Realty, which are also seeing a significant cool off. 3.5% is the kind of cut that you're seeing on Oberoi Realty alone. But yeah, metals also seems to be quite a big drag. Pawan, the indicators that we're seeing from China, wherein, they're trying to pump up the economy, trying for all stimulus measures, but that doesn't seem to be quite playing out within the metals market, which again are seeing a big cool off at play. Do you sense that this is perhaps leading to or hinting towards some sort of, global demand slowdown, the kind of crack in metals?
No, I think very clearly the demand for metals is obviously in China is driven by two things. One is the domestic spend on infra and obviously the global demand. And both the things I don't think are recovering very soon. And in that background, I don't think metal prices will go up in a hurry. I think as far as China is concerned, the local economy have got some very serious trouble. I don't think with a few stimulus packages here and there, the economy can clearly see a U-shaped recovery. In that sense, we are not so very gung-ho about commodity sectors and sectors which are quite volatile in terms of global news flows.
Okay, Pawan, Naresh, we leave it at that. Good having you guys on the show as always. I'm going to hand it over to Snehi then to wrap up how painful today's training session has turned out to be. Snehi?
Well, Aisha, that's how you summed it up, and that's precisely the way to call today's market move. Painful is the word that I would go with as well. Take a look at what the Nifty has done today. A 1.1% cut coming in, 276 points lower. Struggling to even hold on to that 23,600 mark as of now is where the Nifty is. We did hover lower to the 23,500 marks, but slight uptick coming in from the day's lowest point as well. If we take a look at Sensex, however, that is also in tandem with what Nifty is doing. A 1% cut coming in from the Sensex as well. Nifty around 3 p.m. today had slipped below the 200 DMA on an intraday basis. The index is also below 200 DMA for the first time in 18 months. So very big and steep sell-off is what we have seen today. Now, a couple of factors could have dented the markets today. You also had, we've in fact seen 32 consecutive days of FII selling coming in. Along with that, the CPI numbers that came post-market yesterday were also much higher than what the street was expecting. So two reasons why the markets could be ailing today. Let's pull up the broader markets, take a look at what they are doing. And Nifty mid-cap and Nifty small cap cuts of more than 2.5% or roughly 2.5% each coming in for both of those indices. Very steep sell-off coming in the broader markets as well. Let's take a look at some sectoral gainers and losers, and well, there are no gainers today. All the sectors have ended in the red in today's trading session. You have Nifty PSU banks, that's been your top loser in today's trade. A 3% cut coming in on that front. You have PSB, Central Bank, UCO Bank, Indian Overseas Bank. All of these public sector banks have tanked sharply in today's trade. Nifty Realty is your next top sectoral loser. A roughly 3% cut coming in on that front as well. Metal, auto, media, bank, energy, pharma, IT, FMCG in that order. Nifty FMCG, however, is the least losing sector in today's gain. 0.5% cut roughly coming in on that front as well. But well, yes, in excess of 2% cuts coming in for Nifty Auto, Metal, Realty and PSU Bank. Some quick gainers and losers then in today's trade. From the Nifty pack, you had Hero Motor, Hindalco, M&M, Tata Steel, Eicher and BEL that weighed on the Nifty today. However, Britannia, Tata Motors, HUL, NTPCs managed to hold on to whatever little shred of positivity that they could. But yes, lastly to notice, India VIX was up 4.5-5% today. We've crossed that 15 level on the India VIX. So that's also going to be another key metric to watch out for in tomorrow's trade. But yes, this is how we are shutting shop. A cut of more than 1% coming in on the benchmarks today.